Hey there, welcome to the video. Today we're going to talk about a topic I've gotten a lot of interest from via email and comments, so thought it was about time that we discuss. All right. Now, what are we talking about when we say inverse funds, and why am I getting some comments and emails about it? Well, it's because nobody wants this. Right? This is 2025. It's the SPY. Things were going just fine, and then they definitely weren't, right? We started late February, actually, we're still doing fine, and then we hit March, and yikes, and then yikes again. All sorts of turmoil, all sorts of news events, but that was a massive and very, very quick fall, right? And nobody wants that. So, what can we do about it? What are our choices when the market goes so fast and so terribly? Well, when the market goes down really, really hard, the articles come flying out all over the internet. And the advice is just stomach it like they always tell us to, right? The financial advisor industrial complex immediately tells us, well, you just got to stick it out. You just got to take it. Not much fun, right? It goes down. Maybe I'm in retirement. Maybe I'm using the 4% rule, which we probably need to talk about because that seems like a terrible idea, getting worse the more I think about it, the more I study it. But anyway, financial advisor industrial complex says do nothing. Well, okay, I guess that's an option. Or we could get scared. I don't like this, and who would blame you? You could just sell out, just sell everything, and then most likely botch the getting back in part, which is the huge reason articles, podcasts, videos. You can't sell out when the market's bad because no one knows how to get back in. Is that true? Well, unfortunately, the studies show it is true. And an everyday person, probably it is true. Can an experienced trader get in? Yeah, absolutely. There are experienced traders that can time the market just fine. Get in, get out, use indicators, use moving averages. I could show you a bunch of different ways to time the market that are all very reasonable. But that doesn't mean that we'll follow the indicators. Doesn't mean we'll say, yeah, it looks like a buy, but I don't trust it. I'm going to ignore it. So we can all get scared, and scared and fear makes us idiots, right? We get dumber as we get more scared. So there's a chance we wouldn't get back in. And if we don't get back in, then the selling out is absolutely horrific. So not a great option, but it can be done. Or option traders will tell us that we can buy puts. It's a great idea, right? Let's talk about that actually, right? Okay. We're going to do it at two specific times just to try to illustrate what this might be like. Now, let's go back real quick to the chart, right? Things are going down. So let's say in February, we started feeling squirrely, right? So let's buy a put. What does that mean? It simply means a put. You're betting the market will go down, right? You just buy one contract, and if the market goes down, that options contract gets very profitable. I'm not going to get into it. It gives you the obligation, but not the requirement. I can't stand options explanations. I'm sorry. Maybe we'll do it sometime, but it makes me want to punch myself in the neck. But anyway, let's say we bought. This is when the SPY was at 610, right? This is from actual options data and Thinkorswim. So let's say we bought one SPY put, and we bought it at the money, ATM at the money. So we just bought whatever was near the current price. This one was right near it, so I bought it. Didn't do anything spectacular. And I did it, obviously, I'm buying in February. And this one expires in September. So that's March, April, May, June, right? Several months. I'm just worried about the market for the next several months. So I bought one. Okay. Max profit, who cares? That's not important. We're just using this as insurance, correct? And this would have cost us $2,400, $2,402. So we have to spend $2,400 for this piece of insurance. Will it be good insurance? Well, let's take a look. This is that same put on April 7th. So we bought it on 2/19. So not even 2 months later, through March, on 4/7/2025. Oh my goodness. This insurance didn't even pay off. It made us rich beyond our wildest dreams. 372% gain. Our cost of $2,400 has given us a profit at this moment of $8,900. That is some powerful insurance. That is the best. So what are the problems? Well, you have to sell it right then. What if you thought the market was continually going down forever? Well, then when it popped back up, all that profit goes away. So you can ride it until it expires, till the bet is over. The insurance is no longer needed back in September. You can try to time it, and then we get right back to the timing issue. How are you going to time it? How are you going to get out? Nonetheless, if you're just having this in your portfolio, it costs you $2,400 to have a potential gain if the market tanks of a massive amount. Yay, this is what I want to do forever. Well, here's another example. Let's say we sold out, but we still think the market is going down. So we bought another put, or maybe this is the first time we had seen this extremely fast fall, and we decided, let's buy a put. I can't take it anymore. All right. Again, we bought a put. Price is right around $4.95 at the time. Well, that's quite a drop. We bought a $500 put, again, just right near where the price is. And we bought it on April 7th. This one, because of volatility, this one costs a lot more. So this one costs over $4,000. But that's the price of doing business. We need some insurance. That's what we got to do. So we hit send and we bought it, let's say. Not even a month later, how do we do? Oh, goodness. It was up that day, but it's down 62.93%. We're down $2,500. The insurance did not work, right? We are on our way to losing our entire investment, unless you wanted to sell it then for whatever reason, who knows why. A put, if you buy it for insurance, is probably just going to be there in case of. So we'd probably ride this all the way down. And remember, that means we'd have to lose $4,000. That's a little different, right? And it doesn't feel that great. So the question is, do you really want to shell out $4,000 just to watch that position lose for several months? And it'll lose every day. Meanwhile, the market's going up. It's going up, and all your long holdings are doing great. And then, why am I not up more? Well, that's because the put I bought for insurance is getting destroyed. Is that fun? It's not great, okay? So is there anything else we can do? Well, yes, there are inverse ETFs out there. Okay, well, what are those? They simply put, they go up on the stock chart when the market goes down. So if SPY goes down, these inverse funds should be going up again on the stock chart. It's kind of confusing, but you just look at the stock chart, right? If the inverse fund is going down, that means the market is going up. Well, there's a problem there, right? The market normally goes up, and I did a video on YouTube on market predictions for 2025, which wasn't really a prediction. It was just simply the statistics on how often the market goes up. And did you watch that video? Do you know how often on a yearly basis the market goes up? Most of the time is the answer, right? So inverse funds go up when the market goes down, but the market goes up most of the time. See where we're going with this? Which means inverse funds are going down on the stock chart most of the time. Inverse funds will mostly lose. Okay? And maybe they'll provide insurance in bad times. You buy it when you're scared and you feel like a genius, but they will mostly lose, right? Am I saying it enough so that you get the point? That said, here are the only ones I would consider. So let's take a look. Right now, the only inverse funds I like are Fiat, which is the inverse of Coinbase, C-O-I-N, right? It's short Coinbase, meaning that it goes up when Coinbase goes down. This is specific, not the market. It's a specific stock, and it's called Fiat. It's got a massive yield, so if you want income and you don't care about any of this stock chart nonsense, it's an option, right? And full disclosure, I do own some fiat. Okay. Now, how has it done since inception? Well, even in this terrible market, right? February through April, remember how the market tanked? Well, this did great. Remember how the market turned around? Well, this did terribly. And overall, it's down, what does that say? About 18% since we started. Okay? Not great. Not great. But it does pay off. Crash, which is the inverse of Tesla. If Tesla goes down, this goes up. Well, Tesla, ooh, look at that. Tesla was doing better for a while. Then Tesla was doing worse. And then, right. So it is mostly down as we would predict. Even on Tesla, which has struggled at times. It's got a great yield. So again, if you don't care what this does ever, just want the money, then that's an option. But on the stock chart, it's overall a loser, even when you add in the dividends. Here's dips, which is NVIDIA, the short of NVIDIA. NVIDIA goes down. This one goes up. Not a lot here, right? It's down 18%. It's got a nice yield, but that's your NVIDIA insurance. And here's YQQQ, the only index, right? Short NASDAQ 100 option. So if the NASDAQ goes down, this one goes up. Wow. Smaller yield. So it's not as aggressive with its payouts. And if you look since inception, it's about even, right? You can see that line. It's almost the same. So this one pays money, which I like. Doesn't really go anywhere either. I mean, it goes up when the market goes down, but overall, since September 2024, pretty level. Huh. Not quite as down in the dumps as the others. Okay. So let's add this. Let's make a little fun together, right? Let's put this one goes down, this one goes up. They should play off each other, and we should reach a perfect equilibrium. That's what our brain power would say, right? So we use 50% YQQ, our insurance, and 50% QQQ, which is our bullishness, right? How does that work out? Now, I have data going back to September 2024, and that's through May 2025, which is really through April. I don't think the May or the April full data has been in there, but it's close enough, okay? So let's take a look. If you reinvested all the dividends from everything, you'd be a loser from September to May 2025, but the market wasn't doing anything either. So it's pretty close. So meanwhile, you'd be getting a dividend payment, which is way higher than any normal dividend stock, and you'd be holding your ground. Well, that's not bad. Now, what if you didn't reinvest? What if you just put one to counteract the other and took all the money and put it in your grubby little pockets? Well, you'd still be down, but not bad, right? The market would be a little bit negative, and you'd be down 7.7%. Not really terrible, but it is going down. Again, that's only if you didn't take any of the money. So all that, to me, again, you make your own opinions, and everybody's got different needs and wants. But the only one to really consider if you're looking at inverse funds is YQQQ. It gives you a chance to stay almost even, especially if you reinvest. And you can make a modest yield, right? YQQQ returns or offers a 26% yield, but we're only using half, right? We're using half of that and half of QQQ. So you take that 26, divide by 2-ish, and you get that 10 to 13%. Okay? Not bad though, right? You would never, ever get a stock portfolio that's going up. But what you would get is something that's stable with an income that's coming in that's substantial and way better than any dividend stock, right? So something to consider. For me, I'm not looking to really engineer my way around a market drop. If a market drops, the only thing I care about is, am I getting paid? I don't really care about the drop itself, so I'm not really trying to mitigate that. I'd rather just use a trading system, which trading systems can get around these market drops. I've shown tons of them on this channel and talked about tons of them in the free newsletter. I'd rather just use a trading system if I'm worried about drops, or like I said, just simply collect income. And as the market goes down, you get a lower price, which means you get more shares, which means you're going to get more income, and income can be just fine during big market drops. So you don't need to worry about any of that. Well, you can worry about it, but you still have money coming in. The tough part for me is that inverse funds guarantee poor principal performance. The performance of the amount of money you put in, it's guaranteeing it won't go up in the long run. I don't love that. I don't love that. If you're going to use it, at least give your chance. If you're going to trade stocks, at least give yourself a chance to grow if you're looking for growth, right? But even if you're not, even if you're looking for income, it would be nice, even if it does go down. There are several of these income ETFs that might go up over time. This is guaranteeing that it never will. So we can get a higher yield without going inverse on something that's simpler, on an index fund, something like maybe QDTE. That will maybe go up over time, pay a higher dividend, and again, we have the possible upside. So for me, trying to engineer around is not my favorite, but it's not a bad idea, and it's perfectly fine if that's what you want to do, right? Psychology plays a big part in this, and if it makes you feel better, then it's better, period. And don't let anyone tell you differently. If you want to get in the DIP program, you can just email me. You can see information in the description. And that's all for this video. I'll be back soon. Bye for now.